Is Tesla a revolutionary AI and robotics powerhouse, right on the cusp of an explosion? Or is it maybe an overvalued automaker facing, well, a perfect storm?
That's the big question, isn't it?
Exactly. Today, we're diving deep into that tension. Tesla is currently trading over $350 a share. Yet, one analysis we looked at suggests its intrinsic value might be closer to $182.
Wow, quite a gap.
Right. How do we reconcile that massive difference? We're going to try and unpack that for you right now. Welcome to the deep dive. Our mission today really is to cut through all the noise surrounding Tesla Inc., that's ticker TSLA. We're using the latest data, anchored to September 6, 2025, with a closing share price of $350.84 from the day before.
And we've examined a range of sources to pull out the most crucial insights.
So you can quickly get up to speed on, let's face it, one of the most polarizing stocks out there. We'll explore that bullish vision AI, robotics, and also the bearish reality of an automaker facing some really intense competition. Okay, let's begin with part one, the core business and foundation. First up, chapter one, understanding the business. More than just a car company.
Yeah, most people think cars, obviously.
Right, but its business model actually spans three primary segments. For the full fiscal year 2025, analysts are projecting total revenues of roughly $104 billion.
And automotive sales still dominate that.
They do. Projected at $77 billion, that's about 74% of the total. But the real growth story, potentially, is in the smaller segments. Energy generation and storage, that's forecast to surge maybe 45% to $15 billion.
Wow.
And services and other, climbing 17% to about $12 billion.
Okay, but what's really crucial to grasp here is that despite those growth projections, Q2 2025 actually saw a 12% total revenue decrease year over year.
A decrease, okay.
Yeah, and that was driven primarily by a 16% drop in automotive revenues. So it means those smaller, faster-growing segments, they have to scale quickly enough to offset that core slowdown. That's a critical factor for Tesla's huge valuation.
Right. It puts a lot of pressure on energy and services, and their product strategy really highlights this ecosystem approach, doesn't it?
It does.
The automotive lineup, Model S to the Cybertruck and Semi, it's expanding. There's a more affordable next-gen vehicle supposedly due mid-2025. And then the Cybercab, the robotaxi, aimed for mass production in 2026.
Big plans.
Yeah. And beyond cars, the energy segment offers Powerwall Megapack solar solutions. And crucially, services now includes not just, fixing cars and used sales, but also the supercharger network and, importantly, revenue from their full self-driving or FSD software suite.
Mm-hmm. And if we connect this to the broader market, Tesla's position is, well, it's fascinating. Still dominant in many ways, but increasingly challenged. Well, in the U.S., their Q1 2025 sales were actually down nearly 9% year over year, while competitors grew. Globally, China's BYD, they've surpassed Tesla in EV volume. And in Europe, sales plummeted like 40% in July 2025. Their market share there shrunk to just 0.7%.
0.7%.
Wow. Yeah. It paints a picture of intense pressure on their core business. Now, ultimately, Tesla positions itself as a technology company with that mission to accelerate the world's transition to sustainable energy.
Mm-hmm.
They focus on software, over-the-air updates, and tackling range anxiety with their charging network.
Those shifts in market position mean we really need to understand the broader currents. Let's delve into industry analysis.
Yep.
The long-term EV market trend, it still looks strong. Projections are for, 11.32% compound annual growth rate, CAGR, through 2030 and beyond. Global EV sales are still expected to hit 22 million units in 2025. That's up 25% year over year.
But, and this is a big but, the near term presents some significant headwinds. North American EV sales growth is projected at just 3% in 2025.
Only 3%. Why so low?
Affordability, mostly.
Mm-hmm.
The average EV price back in 2024 was hovering around $51,000. That's fueling these intense price wars we're seeing.
Right. And the competitive landscape, you mentioned BYD, it's like a three-front battle now.
Exactly. You've got the legacy automakers like Ford and GM electrifying their fleets.
Yeah.
You've got pure-play startups like Rivian innovating. But yeah, the most significant threat, arguably, comes from Chinese manufacturers. BYD isn't just leading in volume. They're pushing this ruinous price war, as some call it, and expanding globally very aggressively.
And regulations aren't helping either.
No, the environment's shifted. It feels like it went from tailwinds to headwinds. The Trump administration is set to eliminate the $7,500 federal EV tax credit on September 30, 2025.
Okay, so expect a rush before then.
Yeah, analysts expect a pull forward in sales, followed by a potential, collapse in demand right after that deadline. Plus, there are revisions to the Nevi charging network program that sets national standards, which further impacts the industry.
It's interesting, though, how Tesla got here. Traditionally, barriers to entry in the auto industry were sky high, right? Huge capital, scale, brand loyalty.
Absolutely.
Yeah.
But Tesla used that classic Silicon Valley approach. Started high-end with the Roadster, built a premium brand, used high margins to fund development, and then iterated down to mass production.
Sort of inverted the usual model.
Exactly. Let them break through barriers that many thought were, well, impenetrable.
And that approach built this huge brand strength initially. Tesla became synonymous with EV, tied very closely to Elon Musk himself.
Right. But here's where it gets really interesting and maybe concerning for them. A 2025 survey actually ranked Tesla as the least trusted EV brand in the U.S.
Least trusted. Really?
Yeah. Its reputation plunged from very good back in 2022 to poor in 2025. A lot of that seems tied to quality concerns and, frankly, Musk's polarizing public statements. This erosion of trust, it's a significant challenge to their brand power.
Despite that, they still hold some powerful competitive advantages, don't they?
Oh, absolutely. Their gigafactories give them massive economies of scale, vertical integration batteries, chips, you name it, gives them exceptional cost control. That's what enables those aggressive price cuts we talked about.
Like a weapon, almost.
Kinda, yeah. And then there are the network effects. The supercharger network, it's widely seen as the most reliable, the most extensive. And now with Ford, GM, others adopting NACS, the North American Charging Standard, it's basically become the industry standard.
Turning it into a revenue stream.
Exactly, a revenue-generating mode. But perhaps the most powerful and maybe underestimated advantage is Tesla's data network.
The data from the cars.
Yeah. Every Tesla with autopilot hardware is constantly collecting vast amounts of real-world driving data. This data is absolutely crucial for training their full self-driving AI. It creates this incredibly powerful, self-reinforcing flywheel.
Hard for others to catch up on that.
Extremely difficult to replicate. So that data moat, combined with Tesla's identity, they see themselves as a software tech company that masters hardware manufacturing, plus the deep hardware-software integration, the over-the-air updates. It really differentiates them.
Okay. Beyond the tech and the market, leadership is always critical. Let's turn our attention to Chapter 2, management evaluation.
Right.
Tesla's leadership is, well, undeniably centered on Elon Musk. Serial entrepreneur, transformative track record, Zip2, PayPal, SpaceX, Tesla.
Can't argue with the history there. Key operational folks include Tom Zhu, SVP Automotive. He scaled Gigafactory Shanghai, and Vaibhav Taneja, the CFO. Robin Denholm chairs the board.
How have they handled crises?
It's a mixed bag, really. Musk got praise for being transparent about a Model S fire back in 2013. But on the other hand, the company faced criticism for defying COVID-19 orders. And these ongoing TSLA investigations into autopilot and FSD incidents, they keep raising serious questions about safety and transparency.
And speaking of transparency and ethics, there seems to be a bit of a disconnect.
Well, yeah. There's a significant and pretty well documented gap between Tesla's official policy of radical transparency and what seems to happen in practice.
Like what?
We've seen workplace lawsuits, unsafe conditions, allegations of union busting, racism, sexual harassment, even concerns about child labor in the supply chain.
Oof.
And then there was that 2023 report alleging a secret diversion team was set up just to suppress customer complaints about range, cancel service appointments to avoid costly repairs.
That's bad.
It's a major red flag for investors who prioritize integrity. Absolutely.
Okay, so how does this management team allocate capital?
Overwhelmingly aggressive reinvestment for growth. That's the story. Planned CapEx is exceeding $9.0 billion in 2025.
Wow, $9 billion. What's that funding?
Gigafactory expansion, robotaxi development, that next-gen vehicle, AI infrastructure. M&A, though, has been highly selective. The most controversial deal was probably the $2.6 billion SolarCity acquisition in 2016. Critics still call it a bailout.
And returning cash to shareholders, dividends, buybacks.
Simple story. Never paid a cash dividend. They retain all earnings for growth. No significant share buyback programs either. It's a classic high-growth company strategy, bet on yourself.
Okay, but how are those bets paying off? What about return on invested capital, ROIC?
This is, well, illuminating and maybe concerning. Tesla's TTM ROIC as of June 30, 2025 was 7.37%.
7.37%. How does that compare?
It's a sharp compression. Peaks were nearly 27% in 2022, almost 25% in 2023, over 17% in 2024. So falling to around 7%.
That's a big drop.
It's a dramatic decline, a significant warning sign, really. It suggests maybe an erosion of competitive advantages and definitely diminishing returns on those massive new investments they're making.
Those are sobering numbers. Okay, let's delve deeper right into them with Chapter 3, Financial Analysis.
Right.
Tesla's revenue growth trends over the last 5 years really illustrate this dramatic shift. We saw explosive growth, like 71% in 2021,
Incredible numbers then.
but then it decelerated sharply, just 1% growth in 2024. And even more critically, the trailing 12-month, or TTM, revenue actually declined by 2.73% as of June 30, 2025.
So not just slowing down, actually shrinking slightly on a TTM basis.
Exactly. It's not just a slowdown. It feels like a fundamental change in their financial story.
And this revenue deceleration, it's compounded by significant margin compression, mostly due to those price cuts we keep mentioning. Gross margin in Q2 2025 was 17.2%. Down sharply from over 25% back in 2022. Operating margin for the TTM dropped to just 6.06%. That was nearly 17% in 2022. And net profit margin for the TTM was 6.34%, less than half of 2023's 15.5%.
Wow. That really challenges the whole high-margin tech company idea, doesn't it?
It absolutely does. It shows they're susceptible to the same pressures as traditional manufacturers when competition heats up.
And what about cash flow? Free cash flow?
It follows the same concerning path. Peaked at $8.5 billion in 2022, then declined for 2 straight years. And alarmingly, in Q2 2025, they actually reported negative free cash flow of no $1.36 billion.
So burning cash.
Yeah, cash burn. Due to that mix of slowing sales, lower margins, and still very heavy investment.
Okay, so operationally challenged, but what about overall financial stability, balance sheet health?
Actually, despite those operational issues, this is remarkably improved. Earnings consistency is still volatile. Remember, they were unprofitable from IPO through 2019, then peaked at $15 billion profit in 2023, then fell over 50% to $7.1 billion in 2024. Not exactly stable.
Right.
But their balance sheet is much healthier. Their debt-to-equity ratio, for instance, is very healthy at 0.65 as of June 30, 2025. It's a huge transformation from 4.17 back in 2018.
Okay, that's a big improvement.
Yeah. And their current ratio is also strong at 2.04, indicating solid short-term financial health, manageable debt, enough current assets.
All right, now here's where it gets really interesting, I think. Valuation analysis, that PE ratio.
Yeah, the price-to-earnings ratio. TTM is somewhere between 163 and 196, depending on the exact calculation.
163 to 196. Compare that to the legacy guys.
It's stark. Tesla's around, let's say, 180 for argument. Ford's PE is around 8.6, GM is 5.8, BMW maybe 9.4.
So multiples higher.
Oh yeah, an enormous premium. It clearly shows investors are valuing future potential autonomous driving, AI, not just the current car earnings.
Okay, so how do we try to figure out what it should be worth? Intrinsic value, DCF.
Right. Discounted cash flow analysis is one common method. Basically, you forecast future cash flows, you figure out an appropriate discount rate to account for risk and time, and then you discount those future flows back to today to estimate what the company's truly worth.
And you mentioned one educational DCF analysis we saw.
Yeah, from early 2025. It estimated Tesla's intrinsic value at approximately $182 per share.
$182 versus the market price over $350.
Exactly. A stark contrast. And it really emphasizes just how sensitive these models are to your assumptions, especially about future unproven ventures.
What kind of assumptions drive that model?
Well, key assumptions are highly influential. You need a multi-stage growth rate, maybe starting high like 20-25%, but then tapering down to maybe 3% long term. You have to assume significant margin recovery, perhaps EBITDA margins getting back to 15-16% long term.
Which is a big leap from where they are now.
A very big leap. And given Tesla's volatility, you need a high discount rate, maybe 10-14%. The analysis we saw used 13.6%, reflecting that higher risk profile.
Okay. Let's shift our focus now to part 2, market dynamics and future outlook. Our journey continues with chapter 4, market sentiment. This really captures the broader debate around Tesla.
It definitely does.
Analyst price targets, consensus ratings, they reveal this deep division. The overall consensus rating is just a hold.
Not exactly a ringing endorsement either way.
No, but the 12-month price targets range wildly, from a bearish low of like $19.05
$19 to a bullish high of $500. The average is somewhere between $300 targets and $329. So you see analysts like Wedbush saying buy with a $500 target, right next to Guggenheim saying sell with $175. Polar opposites. Perfectly illustrates the split.
What about recent news? What's driving the conversation?
Well, the most significant recent news, the thing grabbing headlines, is probably the Tesla board's proposed $1 trillion performance-based pay package for Elon Musk.
$1 trillion. Seriously?
It's tied to incredibly ambitious targets like an $8.5 trillion market cap, a million robo-taxis on the road, a million humanoid robots.
Okay, that's ambitious is putting it mildly. How's the media reacting?
Kind of a mix of awe and skepticism, you could say, recognizing the sheer scale of the vision, but definitely questioning its feasibility, especially given the recent struggles. There's also been coverage of Tesla's somewhat disappointing initial entry into the Indian market, highlighting those global expansion challenges.
Okay, what about market indicators? Short interest.
Short interest is actually relatively low now, about 76.7 million shares, which is only 2.83% of the float as of mid-August 2025.
So it's not heavily shorted anymore.
No, not like it used to be. This low figure suggests maybe fewer active bets against the stock right now.
And technically, moving averages.
From a technical perspective, the stock is showing some bullish signals currently. The price, $350.84, is above its 50-day moving average. That's a short-term trend indicator, which is around $328.
Okay.
And it's also significantly above its 200-day moving average, a key long-term indicator, which is down around $265. So technically, that confirms a longer-term uptrend is still in place.
Interesting. Now let's look at Chapter 5. Ownership structure. Who actually owns Tesla? That tells us a lot.
It does. Top institutional ownership. Well, institutions hold about 42.84%. That's actually lower than you typically see in legacy automakers.
Lower. Okay. Who are the big holders?
The top three are Vanguard, BlackRock, State Street, mostly passive index funds. So while they provide stable demand for the stock, they aren't necessarily making an active bet on Tesla's specific strategy.
What about insiders? Musk.
Insiders hold roughly 14%. Elon Musk obviously has the largest stake, somewhere between 12.7 and 13.04%. That gives him, well, unparalleled influence over the company's direction.
Are insiders buying or selling?
Interestingly, recent 90-day activity shows net selling by insiders, about $5.6 million worth. And there haven't been any significant open market purchases. Sometimes that can be a signal, though not always.
And ownership concentration. Retail investors.
Yeah, it's highly concentrated. The top 25 shareholders control over 20.96%. But one of the most unique things about Tesla is the unusually large and influential role of retail investors.
How large?
They own approximately 43.16%. That's more than all the institutions combined.
Wow.
Yeah. And that definitely contributes to the stock's volatility and how responsive it is to social media, Elon Musk's statements, and so on.
Okay, let's try and assess the potential pitfalls and upsides with Chapter 6, risk assessment. We can frame this using a SWOT analysis, strengths, weaknesses, opportunities, threats.
Good framework.
So strengths, iconic brands still, the powerful Musk factor, for better or worse, technological and innovation leader, those economies of scale from the gigafactories, and the supercharger network moat we discussed.
Right. But the weaknesses are significant too. That overdependence on Elon Musk creates key person risk, plus all the controversy his behavior can generate. They still face persistent product reliability and quality issues. We've seen declining market share and that margin compression. And fundamentally, their earnings history is still volatile, unproven long-term.
Okay, flip side, opportunities. These are potentially huge, right? Autonomous driving, robo-taxis that could unlock a massive high-margin software and services market.
That's the dream, yeah.
Their energy generation and storage division looks like a strong second growth engine. AI and robotics, especially with the Optimus humanoid robots, and just expansion into untapped global markets.
Big potential upsides. But the threats are equally formidable. Intense global competition, particularly from Chinese automakers like BYD, leading these price wars.
Geopolitical risks, too?
Huge. Geopolitical and trade risks are escalating.
Yeah.
We mentioned the 2025 U.S. government's 25% tariff on imported vehicles, and more tariffs signaled on parts.
What impact could that have?
Projections suggest it could increase new car prices by 10–15%. That dampens demand overall, and it hits Tesla because of their global supply chain and reliance on the Shanghai factory. Then there's the withdrawal of government subsidies we talked about, plus broader macroeconomic headwinds, high interest rates, inflation hitting affordability.
So those external pressures create immense challenges.
Absolutely.
And the impact of key macroeconomic factors, like interest rates, is already hitting hard.
Oh, yeah, acutely. High interest rates, average new auto loan was around 7.6% mid-2025. They severely pressure consumer affordability. It forces longer loan terms, drives that intense price competition across the whole sector.
And the geopolitical factors, the tariffs, just to reiterate that point.
Right, that 2025 U.S. 25% tariff on imported vehicles, more coming on parts, expected to hike new car prices 10–15%, dampens demand. And Tesla isn't immune. Their global supply chain, the Shanghai factory, it makes them particularly vulnerable to these added costs and potential disruptions.
Okay, we've covered a lot of ground today. It really feels like a company at a crossroads. Let's try and bring it all together in Chapter 7, Conclusion.
Let's do it.
So let's synthesize the key bullish points. The bull case essentially paints Tesla not as just a car company, but as this misunderstood disruptive technology platform.
Right, the futures in autonomy and AI.
Exactly. Robotax is promising massive, high-margin software revenues. They've got that unparalleled data moat from the existing fleet, the rapidly growing energy powerhouse segment, and still, the iconic brand backed by Musk's visionary leadership.
Okay, but the bearish points offer a stark counter-argument. Tesla is fundamentally a car company, and its valuation has become, well, maybe dangerously disconnected from that reality.
What do the bears focus on?
Eroding fundamentals that stalled growth, the rapidly compressing margins, declining market share, and crucially, a history of unfulfilled promises. FSD and robotaxis have been just around the corner for years now. Plus, leadership and brand risk Musk's controversies, the company's ethical reputation concerns, those are major issues for bears.
So let's quickly reiterate the valuation summary. Market price as of September 5, 2025 was $350.84.
Right, but remember that educational DCF model we discussed?
Right.
Suggesting an intrinsic value closer to $182 per share.
And it's absolutely crucial to remember that intrinsic value number is highly sensitive to assumptions about the future, about unproven ventures like a fully working, money-making robotaxi network.
Exactly. Which brings us to our concluding outlook. Tesla really stands at a critical inflection point. Its market price, that $350.84, it reflects a profound level of optimism. An optimism that, frankly, just cannot be justified by its current financial performance.